beautiful Friday morning right here in Lagos, Nigeria. Good morning, good evening, wherever in the world you're watching from. It's Business Morning live on Channels Television. I'm Ladi Williams. Great to have you join us. Let's take a look at what's happening with oil prices. We see prices extended their rally today at the end of the third volatile week of trade after slim progress in peace talks between Russia and Ukraine raised the specter of tighter sanctions and a prolonged disruption to oil supply. Despite battleground setbacks and punitive sanctions by the West, Russian President Vladimir Putin has shown little sign of relenting. A fourth day of talks between Russian and Ukrainian negotiators took place by video link, but the Kremlin said an agreement had yet to be reached. Brent crude futures jumped $2.75 a barrel to $109.39 after surging nearly 9% on Thursday, in the largest percentage gain since mid-2020. U.S. West Texas Intermediate crude futures climbed $2.93 to $105.91 a barrel, adding to an 8% jump on Thursday. Despite the rebound, both benchmark contracts were set to end the week down about 3%, having traded in a $16 range. Prices have dropped from a 14-year highs hit nearly 2 weeks ago. And back here, the nation's total debt stock as of December 31st has been put at 39.5 trillion naira. It's against the 32 trillion naira debt level recorded in December 2020. According to the Debt Management Office, the amount represents the external and domestic debt stock for the 36 states and the Federal Capital Territory. Speaking with reporters in Abuja, the Director General of the Debt Management Office, Patience Oniha, explains that the total debt to GDP ratio under review period is 22.5% and is within the nation's limit of 40%. Mrs. Oniha also announced that the federal government's borrowing plan for the year 2022 is 6.9 trillion naira, with both external and domestic debt put at 2.57 trillion naira each. All right, now let's get a reaction from Dr. Muda Yusuf, CEO, Center for Promotion of Private Enterprises. Good morning, sir. Great to have you.
Good morning, Ladi.
Yeah, so debt to GDP ratio under the review period is at 22.5%. Is it time to worry?
Of course, it's time to worry. Because when we have these conversations, it's not so much about the debt to GDP ratio. Because you don't pay debt, you don't service debt with GDP. You service debt with revenue. And I think we must acknowledge that when we apply the debt to revenue ratio, the debt profile is clearly not sustainable. I mean, as at November last year, according to the Honorable Minister, debt service to revenue was 76%. You know, and maybe by the end of the year, it had even deteriorated further. And the amount of money, the actual debt service, was 4.2 trillion. How much did we spend on capital? Even though the DMO is giving us a slightly different figure of about 3 trillion. But when you look at the size of resources that we are committing to debt service, it's really worrisome. Now the fiscal deficit is already about 6.4 trillion in the 2022 budget. Now the president has transmitted a supplementary budget or supplementary proposal of 2.55 trillion. By the time you add that to 6.4 trillion, you are getting close to 9 trillion in deficit. So that means we will need to borrow more. It has become a vicious circle. And this is a very worrisome situation because the total revenue outlay in the budget is 10.7 trillion. So when you already have a deficit of almost 10 trillion, and it's likely to go up harder, you know, it's likely to go up higher because now oil price is over $100. That means the amount of budget we need for the subsidy is even going to exceed the 3 trillion. So at the end of the day, by the time you service debt and you pay subsidy, you have practically exhausted the entire revenue. So how are we going to sustain the system? Are we now going to be borrowing for overhead, for personnel, and for capital budget? So it's really a very disturbing scenario. And I think we need to go back to the drawing board and see what we can do, both on the revenue side and on the expenditure side. Because there's so much talk about revenue, nobody's talking about how to cut expenditure. I don't agree that there's nothing we can do about expenditure. We need to cut down expenditure so that we don't fall into a debt trap. Because if the borrowing increases, a lot of fall back to the CBN to be financing these things, the situation becomes even more inflationary. The amount of interest that was paid on CBN debt as at November last year was 1.1 trillion. That is significant. The full picture of the indebtedness to CBN was not full, but it's not less than 10 trillion. By the time you add the indebted to CBN, you add the AMCON debt, right now, the total debt will be getting close to 55 trillion, which is far higher than what we are even being told now. So it's really the macroeconomic outlook. It's not looking good at all.
All right, Dr. Muda, but very briefly now, what do you think can be done, at this time, realistically, to, bring down this debt stock?
Well, there is very little because we are already committed to a lot of things. Things that need to be done, we have to take some time to crystallize. For instance, we have been talking about some critical reforms in the oil and gas sector, because again, part of the reasons we're in this mess is because of the shape of our oil and gas sector. That sector is putting a lot of pressure on the finances of government. It's putting a lot of pressure on our foreign reserves because we have mismanaged that sector. So we need to accelerate reforms in the oil and gas sector. First, to be able to get more revenue, to address the issues of policy, issues of regulation around the PIA and how we can activate it. Secondly, to address the issue of insecurity. Now, many oil-producing countries are smiling because they are reaping a lot of windfall from the current crisis. But we are here lamenting, which is a paradox as an oil-producing country. Secondly, we need to accelerate reforms to be able to refine locally. The pressure of importation of petroleum products on our finances, on our foreign exchange is too much, it's excessive. So we need reforms to also make that happen. Then we need to deal with the issue of even the cost of the debt. Commercial debts are very expensive. I'm talking about this Euro bond. They are very expensive. And it contributes a lot to the escalation of the burden of debt. We should be looking more in the direction of concessionary debts. So these are some of the, and of course we need to look at our expenditure. Cost of governance. I mean, we are not even addressing that. Because if we continue this way, the macroeconomic situation will continue to get worse. The inflation situation will continue to get worse. The exchange rate depreciation will continue to get worse. Because when you struggle to finance this kind of growing deficits, it creates a lot of dislocations in the macroeconomic environment.
All right, Dr.
Those are some of the things that we need to do.
Okay. All right, Dr. Muda, and obviously borrowing, is getting more expensive with the Fed actually raising rates at this point. All right, Dr. Muda, thank you so much for coming on the show. CEO, Center for Promotion of Private Enterprises. Always great to have you on the program.
Thank you.
All right, now, so, moving on to our next conversation, we see investors are facing the triple whammy of geopolitical conflict with Russia and Ukraine, persistent inflation, and rising interest rates. How would all of these shape individual and institutional investors? Joining us right now is Ayodeji Ebo, Head Retail Investment, Chapel Hill Denham. Great to have you on the program. Good morning.
Good morning. Thanks for having me, Ladi.
Yeah, so, with the recent, ups and downs, in global markets, how do you think this will shape investors' sentiment in 2022?
Thank you. Good question. And I think I would like to just classify the investors into two. We have the savvy, which I'll call experienced investor, that have seen these ups and downs in the market, and it's really no new to them. So in terms of their reaction to the market, will be totally different from those that are new to the market. So for those that are very experienced, and how I feel it will shape their sentiment is that it's always it's always good to keep calm when market is volatile. You need to take your time, because it's proving over time that market will always rebound. If you look at the analysis, you look at the S&P 500 in the last 50 years, market will always surpass its last high. So for the savvy investor, they would have been used to that. They see these ups and downs as opportunity to dollar cost average. And for the new investors, what I would advise is you should keep calm during this period of volatility. This is the time to get into good stocks and own them for long-term investing. Trading is always very tough during this time, and it's good not to trade, not to be active during this period. Looking at long-term investing is what I would recommend for any investor within this period, so that you acquire stocks that we've seen stocks that have been beaten by over 50, 60%. And when you check their financials, they are still very strong, and they still have potential for growth. So by and large, sentiment will be negative, but it's always good to stay calm during periods of volatility.
Yeah, not easy, staying calm, with wild swings, in the equities market, and we're seeing commodities soar to new highs. But what classes of assets do you think, investors should be looking at this time?
Okay, thanks. And I'll believe that for the domestic investors, what I would recommend is their portfolio should be 50% in Naira and 50% in dollar-denominated assets at this point in time. And for the 50% in Naira, I would recommend for the conservative investor to have about 30% of that in fixed income, and have about the balance of 20% in stocks with high dividend yield. So you can set a base of above any stock that can give you 8% and above dividend yield. You can buy into them. And coming to the dollar side, you can also, I would recommend 20% of that 50% to go into dollar mutual funds. And if you have the capacity to buy euro bonds, there are a lot of African euro bonds that are trading at very attractive rates. You can take them. For instance, you see, yes, it may look high risk. The Ghana, for instance, you see some trading at 16, 18% yield. And we believe that the prices would, once prices normalize, prices would rise. And the other 30%, we've seen for foreign stocks, a lot of those stocks, like I said earlier, have been down by close to 60, 70%, but there's still a lot of potential for them. You look at the likes of those that are into electric vehicles. We know with the current geopolitical tension and crisis in Ukraine, we know that a lot of the Euro countries are also even the US are trying to reduce their dependence on fossil fuel. And it means that there will be focus on renewables. So those stocks will present opportunities as we go along. We also know that stocks were beaten this year as a result of expectation of Fed hike. We saw that 25 basis point increase this week. The Bank of England also increased yesterday to 0.75. So that has caused a major decline in some of these stocks, and this is the time that they can also position. It's safer to buy when prices are really very low and have potential for growth.
And the battle against inflation rages on. We're seeing central bankers raising rates globally. How do you think investors can actually protect their investment against the impact of inflation?
Okay, thanks. This is a very interesting question. And the first thing I always like to say as a finance coach is that doing nothing will make you worse. So if you cannot beat inflation, try to bridge the impact. So if depending on your risk appetite, for very conservative investors, yields may be low in treasury bills. You have alternatives like commercial paper that offers higher rates. And when you do those calculations, discussing with investors, it may not be very encouraging. But once you understand that if you don't do anything, you leave your savings in your account earning 0%, inflation will make you worse off. So when you imagine the last inflation rate of February 15.7%, if you just do the analysis, it means if you have saved 1 million in the last 1 year, that would have declined by about 157,000 naira. So if you are able to invest in safe investment like treasury bills at about 4%, or you go to commercial paper, they're also very safe at 8-9%, some as high as 13%, then you are able to bridge a gap. So it's the mentality now is to see how do you want to reduce the impact. And for those that can take a lot or tolerate a lot of risk, this is also the time to get exposed to a lot of foreign stocks. You look at the S&P in the last 10 years, the average return is about 17.7%. That's dollar return. So beyond the adjustment that we make, when you say adjustment in Naira, it means you are up in Naira terms. So I believe that there are opportunities that are less risky, that you have control over, that you can put in your fund. So mentality would have to change, and you need to know that inflation is real and would impact on your savings and investment if nothing is done.
Yeah, inflation, very, very real. But, you know, a report showed that Ponzi schemes are prominent, you know, in a period of low interest rates and high inflation. How can investors avoid being scammed, you know, at these times?
Okay, thanks. You are very right that the Ponzi schemers, this is the time they take advantage of investor psychology, because some investors would look at it, investing in 90-day treasury bills at 1.3%. They won't try that, and they would look for other alternatives. But the best way so that you don't lose your hard-earned savings or hard-earned income is for you to be very mindful and ask questions. First thing is that you would see about Ponzi scheme is they give you guaranteed return, and it's out of. We just spoke about the average yields for fixed income. When you even look at bonds, the highest you get for long-term bond is about 13%, 14%. So when you begin to see rates that are significantly higher than that and is guaranteed, then you should ask a lot of questions. And if you have to do it, just put what you know you can afford to lose. Secondly, most of the Ponzi schemes are unregistered. You have the SEC website where you can confirm companies that are registered with the Securities and Exchange Commission. You can also confirm with the CBN. So you need to also consider that. Thirdly, you would see that for most schemes, they will want you to bring in people before you can be able to reap significant return. So that also shows that they are trying to take funds. It's robbing Peter to pay Paul, trying to take funds from new investors and to pay old investors. So, and lastly, you should also see when their business model is very complex, when someone is trying to explain to you how they make money and you can't understand it within 5 minutes, then you should run, or you should limit your risk. So once you take this into consideration and you take greed out of it, and you remember you can lose all. So if you have to do it at all, put what you feel you can and what you feel you can lose. But it's always good when you look at period of low interest rate don't last for long. You can try to weather the storm and wait, and you would also always see that interest rate would also go on the high side within a short period.
So if I don't understand it in 5 minutes, I run away, and most of these new investing options take longer than 5 minutes to actually understand. But you know, this is a time of they call it the year of the squeeze, rising prices. What's your outlook for inflation in the next few months, and how should investors actually position at this point?
Okay, thanks. It's not looking pretty good when we look at with the hike in global oil prices beyond fuel, which is a PMS that is deregulated, other fuels are not. The diesel, the gas are not, and the cost of production have increased, which has also impacted on cost of transportation. All this would impact on cost of goods. And you also want to look at the major downside. You also look at the expected hike in electricity tariff. That would also impact on the cost of production. So we believe that inflation rate will continue to increase. There's also that food inflation because of insecurity that we would see, and also the impact of exchange rate on imported food. So by and large, it means that investors need to position. So if you need to increase your risk appetite. So when I say increasing your risk appetite, is means that trying to take a bit of risk in investment. So when you look at, for instance, some may be so comfortable with treasury bills, which is around 4.1%. That's government issued. But in period of low interest rate environment, corporates take that advantage to issue commercial paper for them to be able to, which is cheaper compared to when they take loans from the bank. It's good to take advantage of that. And I will always say for commercial paper, don't also be carried away by high interest alone. They all have ratings and you can spread your risk. Diversification is one of the good and very good strategy in investing. You diversify. Even if you see that it's very high, you can reduce the limits that you put into it. So that will help you to reduce the impact of inflation on your investment, because we believe that inflation will still remain on the upside, given a lot of the downside risk.
Right. Every investor looking for that sweet hedge against inflation at this point. Edejebo, Head Retail Investment, Chapel Hill, Dan. Always great to have you on the program. Thank you for coming on.
My pleasure. Thanks for having me.
Okay. All right, so after the break, we'll look at what's happening in Nigeria's banking industry. That's in a moment. Do stay with us. This is Business Morning. Welcome back. The House of Representatives says it plans to investigate the excessive charges on bank transactions imposed by deposit money banks in the country. The House also raises concerns that these charges are sometimes subject to double deductions. Take a listen.
The House is aware that most of the deposit banks in Nigeria impose excessive and non-statutory charges on varying bank transactions carried out by customers. The House is also aware that in January 2020, the bid to, among other things, stop the indiscriminate imposition of charges by deposit money banks, the Central Bank of Nigeria, CBN, issued a guide to charges by banks, other financial institutions, and non-bank financial institutions, stating the approved bank charges to be imposed by deposit money banks. The House is concerned that despite the guide issued by the CBN, some banks still deduct outrageous amounts of money from their customers in the guise of bank charges with different descriptions. The House is worried that in most cases, the deductions are already covered by the CBN-approved monthly account maintenance fee, AMF, those amounting to double deductions. The House resolves to mandate the Committee on Banking and Currency to investigate the excessive charges on bank transactions by deposit money banks in Nigeria and report back within 4 weeks for further legislative action.
All right, now to our next conversation. A report from CBN shows that banking assets grew in 2021 compared to 2020. Let's bring in Adesoji Solanke, now Director, Frontier Banks and FinTech at Renaissance Capital. Join us from London. Great to have you on the program. Good morning.
Morning.
Yeah, so quite impressive results we saw for the banks in 2021 that's looking at asset growth. It looks like it was a good year for the banks. What do you think drove this?
Okay, great. So last year, remember, first of all, we were 1 year post-COVID, and there were a lot of intervention measures by the central bank through COVID. So basically what you saw coming into 2021 was a lot of liquidity in the banking system. So if you also look at deposit growth, which is basically what funded that asset growth, so deposit growth was quite strong. A lot of corporates still not investing significantly domestically, so a lot of cash balances in the system. A lot of intervention funding also coming through from the central bank into targeted sectors. So all of that drove deposit growth in the banking system, ultimately funding asset growth. But unfortunately, when you look at margins for the banks, you saw a decline pretty much for most of the banks, and that's largely because majority of all that deposit growth coming through was mopped up by the central bank through the cash reserve. Okay, but that's basically what happened in terms of asset growth in banking system. I think outside of earnings, the trajectory it could have been worse. Let me put it that way. And I think what really helped the banks was around non-interest revenues. So remember, typically for the last 2 years, towards the end of the year, the central bank has been devaluing the currency towards the end of the year. So what that leads to for the banks is they report significant FX revaluation gains. And that's because of two things. They have these swap positions in their books. And secondly, they have sizable net long dollar positions on the balance sheet. So a slight change in the currency in terms of the currency getting weaker tends to lead to FX revaluation gains on the books of the banks.
Quite interesting. And we continue to see, asset quality trends in the industry improving. Despite the economy having had some shocks, through COVID. Why is this the case? And are the bank books really as good as they look?
That's a good question. The first way to try and assess the banking system is you need to also look at the macro dynamics. If you look at trade to GDP, Nigeria is probably similar to Kenya. It's probably about a third of GDP. But when you dive a little bit deeper into that, you find out that for Nigeria, about 85% of its exports are linked to oil. Okay, if you try and compare that to Kenya, for example, Kenya's trade basket is significantly more diverse. There's tea, there's horticulture, and a bunch of other things. So what all of this means is that for Nigeria, the biggest implication to the economy when oil prices collapsed would have been, yes, the direct impact to the oil book in the banking system, but the second order effect is what all of that tends to lead to, which is a weaker exchange rate, tighter fiscal position, and what all of that means for the economy. But remember that during COVID, oil prices rebounded quite strongly. Secondly, Nigeria didn't lock down for as long as many other markets, even in Africa, or talk less of other developed markets. So basically, the economy didn't slow down as much as we saw in some other places. And I think that also helped the banking system. There were central bank intervention loans and a bunch of other forbearances that came through from the central bank that helped the banks and the asset quality from an asset quality standpoint. Nigerian banks also tend to have a relatively larger exposure to corporate loans, and corporates tend to be better able to navigate crises versus SMEs or retail customers. So this is like a combination of things that happened. And maybe the final thing to say is that coming into COVID, the banks had restructured a sizable portion of their oil and gas loans. They also had hedges in place, which also meant that when oil prices collapsed, the banks didn't suffer as much of a hit to the quality of the oil and gas loans during COVID. So it's a combination of dynamics going on there. But to the latter part of your question, is the quality of the books as good as it suggests? You need to look a little bit deeper, particularly when the way banks report there's stage 1, stage 2, and stage 3. Stage 3 is the NPL bucket. The stage 2 portion are loans that are a bit shaky and questionable, and that portion of the bank's loan book continues to grow. Okay, it's probably about 15 to 20% of the sector's loan book at the moment, and these are loans that are, they are forbearances, they are shaky, there's question marks here and there. They're not meeting their required obligations, but they're not bad just yet. And that portion of the loan book is growing. So it's important to pay attention to what's going on within the stage 2 loan book of the Nigerian banks.
Quite interesting, quite interesting. And margin pressure has been, a consistent, feature in the bank's recent results. What are some of the reasons, behind this? And where do we go from here?
The biggest driver is interest rates. All right, so interest rates have been declining for 2 years now. And from your last caller, you could also hear him talking about the highest rate you could get is probably about 13% on the long end of the curve. But for many of the banks that tended to manage their liquidity positions by investing in short-term instruments, interest rates there are way below 10%. Okay, so this is leading to significant pressure. When you look at the total assets of the banks, about 40% of Nigerian banks' assets sit in cash reserves and special bills, something of that magnitude. And when you just think about that, these are assets that yield 0 to 0.5%. So there's a significant implication for margins for the banks. And when you look at last year, for example, many of the banks did see margin pressure. There were some exceptions. So banks like Access Bank, for example, and UBA. And this is because they tend to invest relatively more in longer dated bonds. So that helped them manage the margin dynamics much better. Now, looking ahead, the question is, where do we go? The liquidity situation is probably unsustainable, just given the country's macro dynamics, or should I say structure. Also, given where inflation is, it's also unlikely that you would see interest rates stay as low as they are for a long time. So I think the more rational thinking is that an adjustment is needed. There's also a fiscal deficit that needs to be funded. The government will need to borrow increasingly to fund that deficit. And to do that, the likelihood is that interest rates might need to pick up. So we need to wait and see how things play out. If interest rates do pick up, this is a significant positive for the bank's margins outlook. It's also possible that to drive lending growth, the banks may also need to have some sort of competition for deposits in that environment. So basically, the outlook from here, I think, is that margins are probably bottomed. And from here, the likelihood is that margins probably pick up going forward.
Right. All eyes on the rates right now. But, private sector credit extension, is captured in another series in the CBN's quarterly bulletin, which covers only lending by deposit money banks. It shows a total of about 21.8 trillion naira at the end of September 2021. That's representing about 17.8% year-on-year growth. What does this tell us?
There was credit growth last year. A lot of that growth went into a couple of sectors. And a bunch of that growth was also driven by the intervention funding from the central bank. So healthcare, manufacturing, a bit of oil and gas also drove that credit growth last year. And I think the final sector that also saw increased credit allocation was general commerce. Okay, the banks are telling us that they think there will still be credit growth this year. Our sense is that credit growth probably slows down a little bit, particularly just before elections. There are some things that could lead to a one-off situation. So there's some demand for credits coming through from oil and gas, particularly given the divestment conversations that are going on in certain places. We need to see how all of that plays out. Sometimes also credit growth is not always 100% organic in Nigeria. And what that simply means is that because over 50% of the banking sector's loan book is dollarized, this also means that whenever the exchange rate weakens, there is an FX implication on, so that 17% number you mentioned, a portion of that was FX driven also, just because of the weaker currency, or should I say the weaker exchange rate that happens in any given year also.
All right, so very briefly now, this issue, the reps probing banks over excessive illegal charges on customer deposits. What do you think about this? And, what's your outlook for the bank's non-interest revenues?
I have to say that the banks charging excessively is probably not unconnected with the general macro challenges that the banks are facing. Remember that one of the traditionally biggest revenue drivers for banks is interest income. Okay, in an environment where your interest income has taken a massive beating and you need to figure out alternative ways to make money, naturally you look at non-interest. Okay, so a portion of that non-interest comes from fees and commissions, which is partly what you're referring to. And unfortunately, it's possible that some banks are charging significantly more than they should. But at the same time, when you look at other categories within non-interest income, this is why FX trading gains have become so sizable. They've grown. The FX trading, FX and revaluation type income is probably 30-40% of banks' non-interest revenues. And this has grown quite dramatically over the last 10 years. Fees and commissions have gone from about 2% of non-interest to over 20% now, right? So there's a lot of mixed shift that has happened over the last decade. But at the same time, I would also say that this probably also suggests why there is room for fintech companies to step in, right? Because some of these fees are not what customers like to pay. And I would also argue that in a more fairly competitive market, the fees are not what the banks should be for. Should I say transaction fees are not what the banks should be focusing on, but rather value-added services. right? This is the trend we've seen in many other markets. And increasingly, I suspect that this is how the Nigerian banks would evolve, particularly now that some of them are moving more to holding companies and trying to figure out other non-traditional ways of generating income outside of what the traditional bank does. So the scope of the banking industry is likely to change. So that's what I'm paying attention to going forward.
Okay, well, we'll see how the outcome, of this probe. Thank you so much for coming on the program. Adesoji Sholanke, Director of Frontier Banks FinTech at Renaissance Capital. Thank you so much for coming.
Thank you.
All right, now let's take a look at what's happening with the markets. We have Aniete right there, standing by. Well, Aniete was mostly positive, earlier part of the day yesterday, but we now saw a pullback, profit-taking right there.
Yes, Ladi, good morning. Yes, just like you rightly mentioned, there was a pullback. The market was trading in the positive territory in the early parts of Thursday's trading session, but the last late-minute profit-taking on the shares of Seplat in particular pulled the market back into the red. And then, of course, we had a $6 billion pullback. So but that's for the equities market, which I'll give you that details much later. But first, let's get started with the fixed income market. Fixed income market, it is still in the bear territory. That's for the bonds segment in particular. Take a look at the screen here. What we had is just about two deals carried out on the 27th of April 2023 paper, as you can see there. The Treasury bills market also, it was quiet. Average yield there closed flat at 3.3%, while for the open market operations, the average yield there, it expanded by 2 basis points. But to give us a clear picture on how the fixed income market turned out, and then, of course, an outlook for next week, let's talk to Chioma Udu, who's a fixed income dealer at GT Bank. Thank you for joining us, Chioma.
Thank you, Anita, for having me. Good morning.
So for the rest of, for the better part of this week, the fixed income markets has not been vibrant as in contrast to what we had last week. So can you give us more insight into this and then what to look out for next week?
Yes, Anita, like you rightly said, it's been a bullish trend because of the liquidity we've seen in the market. This liquidity came from the coupon maturity, coupon payments and OMO maturity. The market opened yesterday about 460 billion. And then today, again, we opened about 200 billion. This is a result of the coupon maturity and liquidity we've seen in the system. We've seen an investment plan across the curve with no much activity on trading on the fixed income, especially on the T-bill space. Well, all the activity we see on the bond space will come from next week, where we are going to have an auction. There's a bond auction next week, 150 billion is an offer on the 2026 and the 2042. So we expect that after the auction on Monday, we're going to see some reinvestment plan because of the coupon we expect to come in next week. So we expect that there will be some activity from next week on the bond space. So.
Okay, so still talking about just one last question before we go, we let you go. We saw that the federal government has raised about $1.2 billion from the Eurobond market, and then Nigeria's debt has climbed up to about 39 trillion naira. So how are investors' sentiment towards the market? So what do you see investors' sentiment turning out on that?
Well, from the description of the auction yesterday, we still see that investors are still very interested in the Nigerian space. So they were subscribed and it closed at about 8.35%. That Eurobond was for support of infrastructure, the budget infrastructure, So we see that the investors are very much still interested in the Nigerian space. And we'll see a proof of that as well at the auction next week. We have, like I earlier mentioned, we have a bond auction, 75 billion across 2 tenors offer, which takes to 150 billion. We expect that the auction is going to be oversubscribed because of the liquidity we have in the system and coupon payments.
Okay, so thank you for that info, Chioma. Of course, we will keep our eyes out. Yep. So that was Chioma Udu, fixed income dealer at GT Bank.
All right, Anita. Well, we'll drill down on what happened in the equities market yesterday, just after this quick break. Do stay with us. This is Business Morning. All All right, we're still drilling down on the markets. We have Anita with the details of what happened with the equities market trading yesterday.
Yeah, thank you, Ladi. So the red picture you see here is how the market turned out at the close of Thursday's trading session, like I told you earlier. And 6 billion naira is what investors, the impact of investors sell pressure or profit taking, if you want to call it that. That's what it had on the market. In terms of the all share index, it had a 0.02% pullback in contrast to what we had in midweek trading sessions, which was up about 0.05%. So, of course, we had a positive market breadth in terms of on the price chart. We had 18 gainers against 17 losers. But, of course, the impact of sell pressure on the shares of UBA, Nigerian Breweries, Honeywell Flour, Unilever, and the rest of them, that's what caused the market to go back into the red region. In terms of sectoral performance, you see it's a mixed picture there. Unchanged, the industrial goods sector has remained unchanged for the second time this week. Banking sector had a slight rebound, but it's just by a tad. Insurance sector was up. That's it. So in terms of month to date, we're in the minus 0.1%, and then in terms of year to date, we have a 10.9% positive. So to tell us more about this market, let's talk to a stockbroker at the NGX, Rotimi Fakejo. Thank you for joining us, Rotimi.
Good morning, Amity.
Now, can you tell us more reason why the market is still, we've had just one positive session this week and then more sell pressure in the last, well, in 3 out of 4 trading sessions this week. So give us an outlook for the market as we speak.
The major reason why we're seeing the present trend right now is that for the month of February, most of the expectations have been priced in. And we saw a surge in prices and an upward movement of the Osha index for the month of February and early March. But as it is right now, what the market is just waiting for is to ratify the corporate actions that have been announced by various companies, that is to mark down their prices with respect to the dividend they have declared. And we are likely to see this present trend continuing until maybe the end of the month, whereby most of the securities will have been marked down for dividend. And the only thing that can trigger the market going forward is if we see something better in the Q1 report than what we see in the previous period last year. And so investors are holding on to what they have now with the expectation of being able to partake in the dividend that has been declared, and more so for the fact that there could be a likely upward trend for the market after the markdown. But be that as it may, we are really not expecting. We've gotten to the peak for at least for this period within this quarter and next quarter, except some unusual good news enters into the market. So for what we have right now, I think the market is going to sail along with it, and there is really nothing unusual that is happening now. So negative trends here and there, marginal, they can still be accommodated in the market. But what we are hoping for is a few of the results that are still remaining, that we may be able to at least lift the market up a little. And one of such is Access Bank. And also we have some corporate actions still outstanding that are not there announced, maybe a stock like Total. So I think maybe when this finally comes into the market, it may actually trigger a little upward movement, but we are not going to see anything fantastic in terms of upward trend for the Osha index for now.
Okay, so now in your definition, would you say that investors are still keen on this market? Because when you take a look at the year-to-date performance at 10.9%, approximately 11%, so do you think investors are still keen on the local equities market?
Well, for me, I think they're already in, and the expectations is still very much high. And I think majority of investors would rather prefer to earn the dividend that has been declared rather than to sell kumpi. So, and that is exactly what we are seeing now. But what may come up after the markdown is what is unclear to everyone. So it depends on how the Q1 results turn out to be. If it's much better than what it is, then investors may hold on. But if otherwise, then there will be a reason for them to at least do a little sell-off in order to at least have a cash flow, pending when markets will be upbeat again and they can return to the market. But I don't think there's any fear that is being allayed concerning the market right now. And I think everybody, things are steady and the market will remain so, at least for the period that the stocks will be marked down for dividend adjustment.
All right, thank you for that analysis, Rotimi. And of course, investors are eyes out for the markets and definitely they'll put their money where their mouth is. Yeah.
So, Anita, well, we'll see how the final trading day for the week today. We'll see how the market actually plays out and if investors come with some buying pressure. Thank you so much for the update, Anita.
Pleasure.
All right, now let's take a look at other markets. We're tracking here. We see the crypto market cap now stands at $1.82 trillion. Is up about 0.33% this morning. Volume traded in the total crypto market about $79.39 billion. That's down. We're seeing volume down there about 16.82%. And we see price of Bitcoin this morning, $40,772. It's still staying above that 40K level. It's had a minor pullback this morning, about 0.42%. Volume traded in Bitcoin, $26.91 billion. And we see Ethereum there, $2,799. That's up about 1.45%. We see Ethereum actually trying to get on that bullish trend there, with bulls pushing Ethereum right above, trying to push it back right above the $3,000 mark. Volume traded $12.82 billion, and we see the top alts by market cap there. We see BNB there, $387. Quite mixed on that counter, with a minor pullback from BNB as Binance token, and Cardano there, 83 cents, down about 1.24%. And we see Solana, $86.06, down about 0.61. XRP, 79 cents, up about 0.54%. All right, now let's bring in Michael Naji now, digital market analyst right there. Great to have you, Michael. Happy Friday.
Happy Friday, everybody. Thanks for having me on.
Yeah, so, yeah, this, we see Russia has been slammed with so many sanctions because of this war in Ukraine. And we see Putin there's claiming that financial sovereign reserves can now be stolen. Is it time for the non-custodial money like Bitcoin to actually take center stage?
Yeah, it's looking quite like that. They're almost saying it without saying it, that they're looking at alternatives like Bitcoin. It's the only thing that makes sense at this point. Because at the end of the day, Russia has their reserves seized now, their U.S. Treasury reserves that are stored in foreign banks seized. And at the end of the day, they can't use those reserves. They tried to do a due diligence of having enough reserve to weather a sanction, but unfortunately, because of where it's stored, ultimately that's what they hit when they tried to get economic sanctions, and so that's effectively crippled the monetary capability of the Russian banks to actually, do anything reasonable or try and help the local economy during these sanctions. And so, it's unprecedented what's going on. Yes, you did have the Assad regime in Syria have some assets seized, and this is not the first time we're seeing, U.S. Federal Reserves, U.S. bonds for foreign countries being seized by the U.S. government. So this isn't unprecedented, but it is unprecedented in terms of the scope and the size of the nation that this is happening. This is the second largest military in the world, being economically wounded in a span of 3 weeks, borderline making them useless. And so it's the Bretton Woods Agreement was signed under the assumption that if the U.S. was going to have global hegemony on the foreign reserves and be the foreign reserve currency of the world, anyone would be able to use that U.S. dollar anywhere in the world, and that would mean, the sovereignty that we grant nations, like, the Russian embassy in New York is the Russian embassy. You can kick diplomats out, but at the end of the day, that soil is Russian soil, as long as it's, under the agreement of, what we've been agreeing on for these past couple of decades. So It's unprecedented to see the U.S. Seize foreign reserves, and that gives a segue to things like Bitcoin, in the sense that as long as you have the keys, as long as you have the capability to move those reserves around, it's unseizable. Not your keys, not your coin. If you have the keys, it is your coin. Unlike gold, which is a bearer instrument, Bitcoin is you can send Bitcoin to anyone in the world. You can put $1 billion of Bitcoin on just a single ledger. It's
Right.
one of the most liquid, most mobile, portable bearer instruments that's unsanctionable to a certain extent. Yes, you can whitelist wallets, but as long as you have peer-to-peer trade on a nation-state level, I find that these whitelisted wallets, the ability of sanctioning wallets when nation states start trading amongst themselves in Bitcoin becomes
Right.
even more harder. Tinted coins now have more demand from these nation states because they're just looking at Bitcoin. They don't care if it's from a hacker or whoever or Putin.
All right, Michael. I guess the debate about between digital gold and real gold rages on at this point. Well, I see El Salvador is back in the news again. They're issuing their Bitcoin bond sometime between now and the 20th. Is this nation adoption of Bitcoin finally in the works?
Yeah. Like at the end of the day, El Salvador is at between a rock and a hard place. Their options are basically soon to either restructure and have to do a IMF package. And we all know the IMF restructuring deals are never pleasant for the nation that undertakes them. Or they can have a second way out, which is Bitcoin. So powered by the Blockstream's liquidity program, people can log into Bitfinex, which is a popular crypto exchange, and they can actually buy this Bitcoin bond. And basically what it entails is there's about 500 million that's going to be allocated mostly through retail investors for now. Most institutional investors are sitting on the sidelines waiting to see how it plays out. And next time, maybe if it goes well, they probably will buy in. But they're looking at about $500 million worth of bonds. And so what's going to happen is out of the 500 million, 250 million will be used for development. And then the other 250 million will be used to purchase Bitcoin. And whatever the upside of that bond becomes, that will be shared with the people who purchased the bond. So people will have the ability to share in the upside of the Bitcoin they purchase with the bond also as well. It's called a Bitcoin dividend. And also they'll have the ability to use the 250 million to finance what kind of activities they want to finance. Namely, the main idea is they want to finance something called a Bitcoin city. But so this is a huge way for them to avoid having to make harsh measures like the IMF restructuring deal that's on the horizon. So hopefully this is a new way for them to source capital. It doesn't involve, the harsh IMF implications that they've had to face in the past. Like you see Argentina, their neighbor had to basically shun digital currencies in order to take a package from the IMF. Okay. And so at the end of the day, this is new world order of currencies emerging right in front of our very eyes.
Right, new world order. All right, Michael Naji, digital market analyst, thank you so much for coming on the program. Always great to talk to you. Enjoy your weekend.
Thank you so much, Ladi.
All right, so if you look at the top 5 gainers list, we see Mina topping that count is up about 27.02% this morning. And PancakeSwap having a rally yesterday. PancakeSwap is up about 13.81%. Looking at the top 5 gainers, we also see Aave and Kusama on that list. Not a bad way to end the week for Bitcoin this Friday. We'll see how the weekend plays out. See the top 5 losers there. CeeLo topping that count is down about 9.53%. All right, that's it on the crypto market. Remember, we at Channel Television do not sell or advise on buying cryptocurrencies or securities. We're a news source, and all we do on the market segment is track it. Thank you so much for watching. Do remember to join us at 1:30 on Business Incorporated for more updates and developments in the world of business. Thank you so much for watching. I'm Ladi Williams. Enjoy the weekend.